Welcome back to Investing Talk Podcast.
Today we're looking at NBIS Group.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
All right, so let's get in the analysis. With NBIS Group, the common thread here is that this isn't just another cloud vendor anymore.
No, not at all. It feels like they've transformed almost overnight into this high-growth AI infrastructure leader.
Exactly. And the financial shift is, I think, the most impressive part. I mean, you've gone from a net debt position just a couple years back to positive cash flow.
While scaling exponentially. That efficiency is really the whole bull case, isn't it?
It is.
And exponential. That word almost feels like an understatement. Let's look at the numbers for fiscal year 2024. Revenue hit $447.1 million.
Which was up a staggering 68.9% year over year.
But you have to look at the engine behind that number, which is the AI compute segment.
That's where the story is. You know, that segment is now, what, 82% of their total revenue?
82%.
And crucially, the growth rate is picking up steam. It's accelerating. That's the signal that institutional money is looking for.
Right.
So that segment's growth went from 51% in the first half of 2024 to an incredible 89% in the second half.
Wow.
This isn't just growth. It's a massive ramp up in demand that they could barely keep up with.
Okay, but what usually happens when you have that kind of hyper growth, especially in infrastructure, is that your margins just get, well, they get crushed.
Absolutely pulverized. You're building data centers. You're buying incredibly expensive hardware. You're trying to compete on price.
And yet, NBIS seems to be defying gravity on this. How?
It really comes down to two big advantages, and they both stem from their vertical integration. First, gross margins in 2024 expanded to 46.7%.
That's a huge...
A percentage point jump in margins while you're scaling that hard is well, it's highly unusual. It suggests they're building out capacity way cheaper than their competitors.
And the reason for that is they aren't just renting compute, right? They own the stack.
Exactly. They operate 85% of their own GPU fleet, so they have maximum control over their spending. The second part of that is their proprietary liquid cooling.
And this isn't just some minor tweak.
No, this is a huge deal. It reduced their power costs by a full 38% per GPU.
Yeah.
When you're running thousands of these things, 247, that 38% saving, that's just millions in pure profit.
And we can see that effect carrying through in the most recent numbers, too.
Oh, absolutely.
Yeah.
Looking at Q3 of 2025, that efficiency has only gotten stronger. Gross margin was reported at 59.12%. It's nearly 60%.
And net margin?
Net margin was at 31.43%. They're generating unbelievable profit during a phase where other companies are still just burning cash to build out.
And the clearest sign they can charge a premium for this is just market demand. Their capacity was reported as completely sold out in Q3.
That says everything, doesn't it? And it's not just small startups buying up this capacity. If we look at their strategic wins, these contracts are market-defining.
Let's talk about the big one, the bombshell agreement with Microsoft. That deal is valued up to $17.4 billion through 2031, and it could even rise to $19.4 billion.
Think about that scale. Their total revenue in 2024 was less than $500 million.
So it begs the question, why does Microsoft, a company with its own massive cloud platform in Azure, need to spend almost $20 billion on capacity from NBIS?
That gets to their competitive mode, which we'll break down in a second. But first, there's another massive deal we can't ignore.
The new contract with Meta.
A $2.9 billion contract with Meta. Again, another tech giant with its own huge internal compute resources, still needing to outsource to NBIS.
These aren't just about raw power then. It's like they're becoming an indispensable partner.
That's the key. And then on the enterprise side, you have the partnership with SAP. That validates their reach into legacy companies, you know, the ones with the absolute strictest compliance needs.
Okay, so headlines are great, but building this capacity costs a fortune. Is their balance sheet strong enough to fund this expansion, or are they just taking on a mountain of debt?
The balance sheet is exceptionally strong. It completely supports the bull narrative. As of December 2024, they hit that inflection point we talked about. They are now in a net cash position of positive $175.8 million.
More cash than debt.
Yep.
And their liquidity, their ability to cover short-term costs, is just off the charts for this sector. The current ratio is at 6.57. For anyone listening, what does that number actually mean in simple terms?
It means they have $6.57 in liquid assets for every $1 of short-term liabilities. Oh. For a company in a capital-intensive industry, that is phenomenal.
So they can go out and buy billions in new GPUs without breaking a sweat.
Exactly. Maximum flexibility. And that financial health shows up in their cash generation, too.
The free cash flow.
Right. FCF for 2024 was $89.3 million. That's a 20% margin. When you stack that up against others in the cloud sector, they are absolutely top tier. They are just incredibly efficient at turning sales into cash.
And management is clearly confident enough to start giving some of that back to shareholders.
Well, that's the signal, isn't it? They authorized their first ever share buyback, a $100 million program.
With $32 million of that already done, that is management putting its money where its mouth is.
Okay, so let's get to that question you asked earlier. Why can't Microsoft or Google just build this themselves? The competitive moat is deep, and it's built on two things: regulation and their own tech.
And the regulatory part is all about what they call a sovereign AI infrastructure ecosystem. This is a huge deal for European clients.
This is the absolute core of the story. NBIS is reportedly the only EU-based cloud vendor that has full GDPR plus data sovereignty certification. Meaning European banks, governments, healthcare companies, they can store and process their most sensitive data on the NBIS platform and know legally it is firewalled within the EU.
And that's why Microsoft and Meta are paying them billions. The U.S. hyperscalers just can't offer that same legal guarantee because of U.S. laws.
Precisely. They are selling regulatory certainty. And that creates unbelievably high switching costs. If a bank wants to move off NBIS to a U.S. competitor, it would trigger all these painful compliance audits.
And model retraining.
The estimated cost for that migration is over $2.1 million per client. That kind of stickiness. That's a powerful defense.
So the moat is regulatory, but they also have their own tech making them more efficient. You mentioned OptiGPU and NBIS Flow. Let's simplify those.
Okay, so these are the crown jewels. OptiGPU is all about dynamic GPU partitioning. So think of a really expensive GPU card. Instead of selling that whole card to one customer,
Right.
OptiGPU lets them dynamically slice it up into smaller, high-performance virtual pieces for multiple clients at the same time.
So it's like making sure every seat in their most expensive asset is always filled.
That's a perfect analogy. And the result is a 68% reduction in hardware idle time. That flows straight to the bottom line. Then there's NBIS Flow.
The routing algorithm.
Right. It's an AI workload routing algorithm. It finds the fastest, cheapest way to process any AI query. For the client, that means a 22% reduction in their cost per token versus running on a competitor's cloud.
Okay, this all sounds almost too good to be true. Every company flying this high has risks, especially with that valuation. Let's touch on the capital market side first. How are they funding all this?
They've been very smart about it. They just did an underwritten offering and issued $3.16 billion in convertible notes. And the key is that those notes mature way out in 2030 and 2032.
So debt investors believe in the long-term story.
They do. And they also set up an at-the-market or ATM equity program. It's basically a vehicle that lets them sell shares opportunistically when the price is high to fund more growth without the big disruption of a secondary offering.
And the big institutions are buying in.
They are. We're seeing major asset managers increasing their stakes. The big money believes this growth story is real.
And from a technical perspective, the stock chart also flashed a pretty major bullish signal recently.
It did. The Golden Cross was confirmed back in February 2025. For anyone who doesn't follow charts, that's when the 50-day moving average crosses above the 200-day. It's a classic signal that the long-term upward trend is expected to continue.
So let's look at the near term. What are the big catalysts coming up in the next 3 months?
The biggest one is the Q3 2025 earnings release. That's expected in February 2026. This one is crucial. Management has to show they're successfully deploying all that capital they just raised.
And before that?
Before that, you have ETF index rebalancing in December. That could drive a lot of passive buying. And then the institutional buying window opens up again in January.
All right, we have to talk about the risks. Let's start with the elephant in the room, the valuation.
You have to. The forward PE ratio is, well, it's around 403.
400.
That multiple tells you one thing. The market is pricing in perfection. Decades of flawless, massive growth. There's absolutely zero room for error. If they miss guidance by even a little bit, the stock could get hammered.
And it's not just about execution, it's about the efficiency of that execution.
Precisely. The whole bear case centers on their capital expenditure efficiency. Analysts are watching one benchmark like a hawk. Can they keep their build-out costs below 2.5 million euros per exaflop?
Okay, you threw out a technical term there. What is an exaflop and why is that the key metric?
An exaflop is just a measure of computing power, a massive amount of AI power. The benchmark, that 2.5 million in exaflop, is how analysts measure how efficiently NBIS is building new capacity, if that cost starts to creep up.
The whole high-margin vertical integration story starts to fall apart.
And so does the valuation.
Understood. Now, we also have to talk about the insider sales. The story seems perfect, but some people on the inside have been selling a lot of stock.
Yes. We saw filings for insider sales totaling over $187 million back in September. And while, insiders sell for lots of reasons.
Sure. Diversification, taxes.
Right. But the optics of selling nearly $200 million worth of stock right as the company's hitting its stride, it does create a bit of a camera narrative. It raises a fair question about whether they think the stock has peaked.
It's a tension point you have to be aware of. Before we wrap up, let's touch on the speculative chatter. And we should stress, these are just unconfirmed rumors.
Strictly rumors. There's chatter about a potential private equity buyout. Consortiums like CVC and KKR are supposedly kicking the tires. A buyout would likely have to come at a huge premium.
And there are also rumors about more strategic partnerships.
Exactly. The word is they're in talks for a white label deal with a major German cloud provider, people think T-Systems, to basically become their AI infrastructure backbone.
And the most interesting one involves Meta.
Yeah, the rumor is that Meta is looking to offload 20% of its massive GPU workload from U.S. providers to NBIS. It's part of a strategic de-Americanization push. If that one turns out to be true, it would just be rocket fuel for their growth. So at the end of the day, what you have with NBIS Group is this really compelling growth story. They've cemented themselves as a key player through these massive contract wins, supported by incredible margins from their regulatory and tech advantages.
But the question is simple yet monumental. Can management execute their expansion plans efficiently enough, keeping that critical cost per exaflop in check, and fast enough to justify the market's sky-high expectations? The next few quarters will tell us everything. If you want to keep following these key developments in the AI infrastructure market, make sure you subscribe to Investing Talk podcast. We'll keep tracking it for you.